Nowadays, there are a lot of investment options, and it's difficult to decide where to invest. There is also a confusion about whether to invest in the share market or the debt market. But what if you can get away to invest in both of them simultaneously? One such alternative is a market-linked debenture. A debenture is a debt instrument through which companies raise money from the general public. Now, these market-linked debentures are linked to the share market. Market-linked debentures, that is MLD, are structured fixed income instruments that pay the principal and market-linked returns on maturity. The return on investment depends on the performance of the underlying index like Nifty or instruments such as GSEC.
The structures include both principal protected MLDs and non-principal protected MLDs. NPP MLD has higher risk because there is a fear of losing principal amount. MLDs do not provide any regular fixed coupon payout, and investors receive a single bullet payment directly from the company at the redemption time. The redemption amount includes the principal amount as well as the coupon amount, with no payments made during the duration of MLDs.
These instruments are generally issued for a tenure ranging from 13 months to 60 months and entail a high investment ticket size. They are typically preferred by the high net worth individuals, that is HNI category of investors, as the minimum investment of 10 lakh rupees is required in MLDs. Now let us see how MLDs work. Let's use the Nifty 50 as the underlying index, which is now trading at roughly 18,000. For instance, a PP-MLD may promise to pay a 15% coupon if the Nifty passes 19,000 at the end of its tenure. If the Nifty crosses 19,000, you will be paid a 15% coupon. The issuer will only repay the principal if the requirement is not met, that is, if the Nifty doesn't cross 19,000. That said, in the above example, even if the Nifty stands at 19,000 or 22,000 on MLD's maturity date, the coupon is fixed at 15%. Thus, as an investor, you can profit from the rising underlying asset, that is Nifty 50, ETF, gold, GSEC, etc.
Now let us look at how MLDs are taxed. They are taxed the same way as bond or debentures, meaning they are alternatives to save tax. MLDs are attractive even from a return point of view and also from tax perspective. However, there is a lot of risk in it. The issuer usually comes up with an MLD issuance since he is unable to raise funds at a low cost. From an investor's perspective, this should be the first filter while subscribing to such an issuance. The second risk is liquidity. Since the principal and returns are paid at the time of maturity, a longer tenure MLD effectively locks in the funds.
Sumit Chandra, founder and CEO of Jarvis Invest says, and I quote, "If the investor is experienced enough to be comfortable with the risks of these instruments pose, then allocation to MLD can be a good way to increase up the overall yield of one's investment portfolio." Many reputed companies with great credit scores have entered this market. An investor therefore can choose from a large selection of debentures with a high credit profile and various underlying markets.